Good evening, everyone. You're all very welcome to this week's weekly market Zoom webinar, hosted here at Educate to Trade. Of course, we will be looking at all of the key themes and major events through the course of the week. I suppose on a day performance, we've obviously seen equities still hold up. We are seeing this uncharacteristic September rally do quite well overall. Now we are getting a little bit of a corrective move overall since about the afternoon, but you have to look at markets on the higher time frame just for perspective, really, just to see how aggressive this September rally has continued to be. There was moments last week where we started to see a little bit of a hiccup, a little bit of a pause, particularly last Tuesday into last Wednesday. And of course, we've really seen that cemented following FOMC last week, which has seen these markets again creep higher. So if we were to recap from last Wednesday's FOMC, a very sharp corrective move, really symbolized by this kind of V-shaped bottom, particularly in the lower time frames. And really since then, it's been all-time high on Thursday, all-time high on Friday, an all-time high again into Monday, where these markets technically opened up higher at the beginning of this week. Now we have seen a little bit of an apex, a corrective move back lower, sub 6,700, but we've gone from 6,350, 6,400 at the beginning of the month to 67 as we entered today's US session. So as I said, a little bit more corrective on the back foot today overall. But again, not a massive knee-jerk reaction considering how aggressive September has been. And when you actually look at the grander scheme of things over the last few months or so, we have seen just a continuation in surge in price action to the upside. So we talked about how the S&P was going to be very similar to what we saw in the DAX, those higher time frame moves in Q1, where we had this basically this V-shaped bottom, and we had this really aggressive grind really into April, May, and of course June. And we're seeing kind of a delayed reaction in the S&Ps, but I would not be surprised if we saw this type of move continue in the S&Ps over the coming weeks, where we kind of see those reverberations of what we saw in the DAX in Europe in H1 to what we're seeing in the NASDAQ, the S&Ps, and of course the Dow Jones. And we talked about it vividly over the last 6-8 weeks, of how that we were looking for the equity markets in the US to really rebound into the summer and really into the back end of the year, as obviously changing fiscal policies, Fed cutting rates, the likelihood of potential for QE to spring up, and that has been reverberated in the equity markets, where we've seen continuous consecutive weekly all-time highs in the S&Ps and in these equity markets in the US. And of course, same can be said on the higher time frame for the likes of the NASDAQ, albeit corrective today. Almost identical situation. Okay, we've broken up. We had this little bit of a pausing area, but broke aggressively through it, and there's been absolutely no sort of correction or relief rally back into this strong liquidity area. It's been all-time high after all-time high, corrective bottoms, new lows continue to form, and again over the last 2 or 3 weeks. So this has been the centralized theme. These equity markets continue to grind higher, continue to robust higher, and I think this is what's important when you look at the fundamentals, when you look at the macro side of things. You can really start to hone in on the higher time frame perspective, but also, as I said, if you want to proactively trade the lower time frames off your value areas and your volume profiles, you have the liberty to do the same as well. So it's quite an interesting theme that's developing over the last few weeks. Obviously, Europe, we've seen Europe consolidate. We talked about it. We were really looking for the DAX to potentially break new lows. We did manage to get a new low yesterday. A new low last Thursday and last Tuesday, followed by a corrective move into the tail end of last week. And that's been pretty much seen. So this idea of US equities outperforming Europe is very much pivoted here. And of course, as you look at the DAX as well, it is poised for more lows. So it'll be interesting to see whether that continues to break down. But I, for one, would be watching this DAX play lower over the coming days and weeks. And of course, we saw the FTSE play, right? Very aggressive in the UK. It's created tops around 93.50, little under 93.50. It certainly looks like it's coming a little bit more corrective as well. So this theme, this narrative of seeing equity markets in the US rebound into H2, it's very clearly to witness, right? In the first, as we approach Q3 end this week, we have seen very little of a respite. Not to say we can't see corrective moves over the next week or so in the S&Ps and the NAS and the Dow, but overall, these market themes is still holding up excellently well. Now, the only thing I would say is, as I said, we've seen this very aggressive move from 63.50, 64s up into 67s. On the NASDAQ, we went from 23 handle all the way up to 24.8, of which was tops today. So that's an 1,800 point move in over the last 3 weeks. And of course, the Dow Jones on the higher time frames, it too has expelled higher, taking out those all-time highs from December 2024 and January, February 2025, only to kind of create this staircase formation: breakout, retest, breakout, retest, breakout, and pulling back to retest again. So wouldn't be surprised if there was a little bit of a correctional movement in all equity markets this week, particularly of course when you see this kind of successive grind. Like you look at the Dow or the S&P really since the beginning of the month, from the 2nd or 3rd of September, we've only had 3 negative trading days in the last 20 days, and that's obviously including weekends. So it shows that these markets has been thoroughly outperforming to the upside. Now, of course, when you look at the downside, you don't obviously want to fight you don't want to fight a trend that's as aggressive as this, but it's absolutely no harm on the lower time frames if you can get those opportunities, get those counter trend moves back to prior day value areas, back to consolidationary zones from where price action broke out from. Right, you only have to look at here, for example, on NFP last Wednesday, aggressive move into a kind of a period of consolidation Wednesday, Thursday, Friday, and of course breakout, price actions pulling back. So logically over the next kind of 24-48 hours, this area here around 65.50 is really going to be the break or bounce for a new high, or incrementally for a bit of a correction move back down to last week's FOMC price point, where it was basically 65.50, 6600. So naturally the prior day value areas in the short term time frames, is really giving you kind of that buffer to say, well, where are these obviously breaking out? And as I said, the Dow is prime example of that, right? We broke up, we came back, we mitigated, we retested, we went into this period of zigzag consolidation. And then of course what happened? We had inside structure followed by breakout, followed by correction, and markets ultimately halted. And then of course again continuation moving higher, 2 or 3 day period of consolidation. When you look at price action structure, very consolidated. And then what happens? We extend higher today, massive, I wouldn't just call it manipulation, but a massive liquidity sweep, apexing up, breaking highs, and structurally creating that corrective move back down. And as I said, this value area here is incrementally going to be very, very important over the next few days. So this area around 46,200, I can even draw it out with a highlighted zone, is going to be very, very important, right? So for me, this area here is going to be structurally important if it's going to hold this kind of higher high, correctional movement, apex, go back to value area, and they become the themes and narratives to look out for. So overall, on the higher time frame approach, very little has changed from our narratives last week. Very little has changed from the week before. We saw buying into the FOMC. We saw extensions through that. We've seen buying into last week's close. We've seen initial extensions higher at the beginning of this week, followed by a correction obviously today. So naturally we have to see things as progressive as they are, and that is equity still holding its risk tolerance. Now, the only side thing to that is obviously bringing back in the VIX, and the VIX spiking higher into 17 tonight is probably the prerequisite that we needed for this apex, for this corrective move in the likes of the NASDAQ, in the likes of the Dow, in the likes of the S&Ps, back to yesterday's value area, but kind of just mitigating some of this aggressive buy side. Because when a trend is so aggressive to the buy side or even sell side without little kind of correction movements, you're kind of prone to then sharp knee-jerk reactions if it becomes overextended. And that really is becoming the kind of the telltale sign, because of course, as I said, from last Wednesday alone, the NASDAQ was trading at 24.1. It went 700 points in 3 trading days, which again shows how nuclear these equity markets can be on both sides of the equation. We saw in March and April how corrective it was to the downside, but we're also seeing when it wants to move to the upside, it can do so very, very freely and very, very aggressively. Okay, but as I said, we've been kind of following the VIX all year. We use it as a very, very strong tool to identify risk sentiment, particularly on the shorter time frames from a session to session, because of course it gives us our gaps, it gives us our knee-jerk reactions. So of course, obviously the FOMC sell-off into VIX formed up bottoms last week. VIX from Thursday, despite the equity markets actually doing quite well, right? Of course, the VIX today, for example, gone from 16 to 17, and that was witnessed in this corrective move back down. So just because the VIX over a 2 or 3 day span is going from 15 to 17 it doesn't necessarily mean that the indices will be going off in that 2 to 3 day period. It just kind of depends on a session to session basis, and that's why obviously looking at the gaps, looking at the open interest, looking at the liquidity, looking at the ladders, looking at the volume is uniquely very, very, very important. And of course, as I said, with that little short-term pickup in the VIX today, it's created that knee-jerk reaction. S&P's back down to Thursday, Friday, Monday's value area here in yellow, right? NASDAQ, similar type of formation here, back down to where it traded pretty much Thursday and Friday. So you'd expect that 24,500 to be a very, very interesting level over the next few days. Similarly with the Dow at 46.2. So these highlighted yellow areas are the trigger points really to evaluate price action as we move into Wednesday, as we move into Thursday, and as we get our last full trading week of Q3 2025. Now, as we look at the calendar, just to remove the notifications just there for a second, we have month end coming in next Tuesday. So we've got Monday and Tuesday next week full trading to end out September. Then we move into Q4, right? And then we get the seasonality effects of what we think generally is a more bullish month. Now, given of course how bullish September has been, don't be kind of under the illusion that September can't be a negative month or there can't be corrections, because of course, as we alluded to earlier, when the markets have been so aggressive for a period of time, there's always going to be knee-jerk reactions. There can be any narrative, any news outlet, anything can pose as a correction or pullback in these markets. But as I said, if you look at the volatility curve, you look at sentiment, you can start to front run some of the risk. And of course, we've seen the volatility curve pick up from last week, and we're seeing that play out in some of those correctional movements in the equity markets today. So where does that leave us then into the close? Well, it leaves us with the DAX on the back foot. It leaves us equities in the US on the back foot on the session. But overall, you would actually still say in the US at least, these markets are continuing to be very forthgoing to the upside. And I think that's important as well, to know how long is a piece of string, right? We talk about this quite a lot on our channel, not being able to be too greedy, right? Not being kind of too excessive in our approach, making sure that there's good risk management. And these are all centralized themes and important themes, particularly when you look at volatility, when you look at sentiment, and of course when you look at obviously the news and fundamentals as it flows in the back end. So that's where we are in terms of an overarching view. In terms of the actual news fronting it, obviously this week we've had a raft of PMI data prints today. I think this is kind of when we look at the calendar, I think some of these data prints has been quite muted today. German data, you have to look at it in three parts. When you look at the PMIs, you've got composite, manufacturing and services. Obviously services being services, manufacturing being manufacturing, and composite being a composition weighting. So of course manufacturing, we know globally, has trailed to services over the last number of years, right? All of the times that's been reported, generally speaking, the services PMIs are better performing. So that's no surprise when you compare German services PMIs to the manufacturing, right? Naturally, 52.5 to 48. Similarly in the Eurozone, 51.5 to 49.5. And of course, even in the UK, global services, 51.9, manufacturing really coming in under disappointing at 46.2. So, and again, similar type of scenario in the US as well, 53.9 compared to 52. So you have to look at all these data prints. Overall, I would say it's a mixed print today. Some okay figures in Germany, but obviously manufacturing is the centralized weaker team across the board, right? Whether it's Germany, Eurozone, UK or US, manufacturing is the worst performing of all, okay? You'd actually have to say that the US data prints overall has been pretty good. Services coming in as expected at 53.9, albeit less than 54.5, the previous print, which is a little bit of a cause of concern when you'd actually expect to see the business cycle kicking on into Q4 and obviously Q1 2026. So that'll be something that I'll be looking at closely to see, to make sure we get these PMIs, particularly services composition weightings anyway, moving up into those high 50s, 56s, 57s, 58s, 59s. And that really kind of gives us the trigger point that this economy side of things from a business cycle is actually outperforming and is doing better and attributing more wealth to the actual overall economy, not just artificially attributed to higher stock prices because of lower rates or an introduction or reintroduction, should I say, in QE. So this is obviously important, right? So when we look at business cycle, we obviously look at fair prices, which is the Fed's mandate. We look at full employment, which is the Fed's mandate. But from a business cycle, when we look at growth, that is really what underpins it, and that is really going to be the centralized theme. Overall, I've been no kind of hidden surprise to say the growth cycle in Europe has been pretty lethargic, pretty mediocre. We see it in the month-on-month Q-on-Q GDP figures in Europe and the UK at 0.0, 0.1, 0.2, with regressions on occasions. So we know that the growth cycle or the business cycle in Europe has been lethargic, right? And we can talk till the crows come home about why or what is attributing that. Well, you can talk about politics, you can talk about compliance, you can talk about regulations, you can talk about the whole business environment and the establishment of business environment in Europe more broadly, and that's obviously inclusive in the UK compared to a much more open economy that's obviously been visible in the US. But nevertheless, this is obviously what we're going to be looking out for. So overall, as I said, a takeaway point today, I would say that these PMIs in Europe, far from confident, mixed, right? Particularly in the UK, all numbers come in less than expected. In the European Union, EU figures more broadly, again, pretty mixed, right? Services and composite was higher, but manufacturing was down. Same with Germany as well. And obviously the French economy obviously really struggling as well, like that of the UK. So as we move into the betterment of this week, tomorrow is not really a busy day in terms of news. We have got German IFO data tomorrow morning. Again, business climate, current assessments, expectations, etc. So that'll be an interesting one because the reports for September. But really the bigger day for me is going to be Thursday this week. Of course, we've got GDP numbers, really going to be interesting as we close out September, right? The GDP product price index at 2%, that's roughly in line with the inflation prints or the longer term inflation levels at 2%. That for me is fine, no problem with that if that's coming in around the 2% level. But really more focus is going to be geared towards that GDP figure at 1:30 on Thursday, okay? And seeing whether we can beat or match this 3.3 print. Now, what we obviously want to look at in terms of the GDP figures, we need to look at consumption, right? Consumer consumption in the economy. We need to look at imports. We need to look at exports, right? So obviously the effects or the associated effects to tariffs is going to play into the imports, exports discussion point. We obviously have to look at government expenditure, government financing, okay? And that is going to become quite important as we move out of September into October, because of course the potential shutdown in the US economy is not a million miles away too. That's going to be the next big discussion point as we move towards the end of September, beginning of October, because of course refinancing of debt, and obviously that's something we've talked about quite a lot over the last number of months in terms of the Fed or the administration under Trump wanting to get these rates as low as possible to refinancing this debt at lower levels, lower interest rate levels, which becomes more accommodative. So there's a lot of trigger points. I think overall the GDP figure on Thursday should be relatively strong looking at recent data prints. But of course, if we were to see a miss, that all of a sudden opens up the Fed again to a more aggressive stance in terms of cutting rates. So let's say, for example, we were to see GDP at 2.8, 2.9% and moving lower. That for me would be a cause of concern, because that's showing that what we've talked about with the Fed being behind the curve, 6 to 12 months behind the curve, really starting to play out, right? We're seeing the labour market showing fragility. We're seeing the JOLTS numbers obviously continue to decrease. Now we have seen a little bit of a marginal bounce back last month, but if we start to see the GDP figures start to become lower or more entrenched downside, going back under 3%, that is going to really ask some serious questions of the Fed, because of course the GDP numbers are moving lower. The NFP benchmark recently was 1 million jobs lower than what they expected, right? Normally it's about 500 to 600,000, but it was 940 odd thousand or 960,000 this year. So it shows that these inherent cracks in the markets are there. So this is obviously going to be something to look out for. We obviously want to look at business cycle, and we'll continue to evaluate the business cycle as we move into October, November, December, Q4, okay? But we'll obviously continue to look at the likes of GDP, the likes of NFP, and really how does the Fed continue to justify keeping those rates at much higher levels when really and truly that's probably not where really they should be. And we've talked about it, I've talked about it at length in previous calls, but probably the Fed should be about 3.25 to 3.5%, but it's at roughly 4.4% at the minute. So 4 to 4.25. So this is obviously where it's quite important as we move, as I said, out of September and obviously into Q4. Now, for me, obviously Friday, we follow it up with more data prints, because of course we then look at the core so core personal consumption expenditure. It's the price index. Both the headline and core prints are out on Friday, and that'll be an interesting narrative as well, because of course, for those of you that don't know, per core personal consumption expenditure is exactly that. So it looks at it looks at the gauge. So it's the Fed's preferred gauge of inflation firstly and foremost, but it looks at, as I said, tying back outside of traditional inflationary metrics, where and what aspects is the consumption expenditure being driven by. Okay, so we talk about, when you look at the CPI composition weighting for a moment, we see that the accommodation and rent sector, or rent proportion of the CPI, takes up such a heavy weighting. So it doesn't obviously look at CPI, it looks at other things as well. And I think these price index is obviously quite important, because of course higher prices ties back into indirectly the price mandate by the Fed. The Fed aren't just looking at, when they say price, stable prices, they're not just looking at stable stock market prices, they're looking at stable price in the economy, the cost of goods and services for any given product at any given time. So this is obviously quite important as well, and will be a very, very interesting figure as we move out of this week. And of course we've got GDP on Thursday with durable goods orders. We've got core PCE on Friday with Michigan Consumer Sentiment Indexes, and it'll be very, very interesting to see whether there's a more deeper entrenched kickback in these equity markets, or if it's simply a case of higher high, higher low, corrective movement trend, and we see this kind of staircase effect continue to play out in these markets if the data prints remain solid. Now, the other thing I want to look at tonight is, obviously over the last few weeks, we know equity markets in the US in particular has been absolutely flying, right? S&Ps, NASDAQ, Dow. We know we've got a counter-cyclical effect in Europe, but we've talked about that. We've kind of navigated around that. We kind of noted how we believe that the DAX is obviously ahead of the curve, and of course the US equities is kind of that cyclical rotational play, right? DAX was the front runner through Q1 and Q2 with the Euro stocks and a lot of these other international-based equities like the Nikkei in Japan, the ASX, the TSX, and of course the FTSE in the UK. But we're seeing a cyclical rotation, and we talked about that over the last few weeks, that we would expect, if you were to compare the S&P to the DAX, or even the Dow to the DAX, you would expect those weighting to actually obviously increase into the backdrop of end of year cycle, and we're kind of seeing that. But what I want to kind of shift out of that to, not to repeat, is the inverse relationship of what we're actually seeing in the crypto markets, because of course the crypto market seasonality of a weaker September, albeit the first 2.5 weeks was very, very positive, we're getting that knee-jerk reaction. We got it initially last Friday. We got it initially then followed through on Sunday into Monday, where we see a lot of liquidations by Binance, a lot of liquidations by some of these exchanges. We even saw rumors of BlackRock selling 900 million of Bitcoin. But there's a lot of FUD. There's a lot of FUD, and I think there's a lot of trying to justify seasonality factors. We know traditionally September is a volatile month, and often more not, if you were to look at previous cycles in crypto, it often is actually a negative. And I think if you were to look at the last 10 or 12 September months, I think there's about 8 or 9 of them proves to be net negative for the September month cycle. So naturally there's going to be a knee-jerk reaction there. But funnily enough, interestingly, it's getting that knee-jerk correction, right? Of course, Bitcoin has been very, very aggressive over the last 6 months or so, from really the insertion of Trump last December, where we knew he was going to win, where we had that massive breakout on previous highs. But now it's more cyclical. Now it's more correctional movements. We're getting that September seasonality, and it'll be very, very interesting to see whether we get further selling. At least in the short term, it'll downside, because of course we've had that kind of that truck and trailer like formated move. A very, very aggressive move up, apexing, consolidating, and unwinding again. We talked about this 113 level last week, how that was kind of structurally important moving into FOMC. Now, it held up into FOMC. We had that extension kind of Wednesday, but Wednesday was really the top where we started to see markets really crack in the crypto space. And of course, as I said, when you saw the entrenched volume of stop hunting and liquidity on leverage in these markets by Binance through Wintermute, it really kind of illustrates the fragility of the stock market from the crypto market, should I say, because of the unregulation, because of the dark pools, because of everything that goes on behind the scenes. And this is something, obviously, if you're trading cryptos on leverage, this is something that you need to be very, very careful of, that anyone with a brain, needs to look at the bigger picture. When you talk about the seasonality factors, when you talk about the cycle analysis, right? We know that September is going to be a generally a negative month for crypto, and has been, and obviously continues to play out. Now, in fact, we're still up for the month of September, but I would not be surprised if we saw more downside because of that entrenched short-term liquidity induced volume to the downside. And we're seeing it in BTC. We're pretty much seeing it across the board. Ethereum as well, very, very corrective. We went from 4.6 last week, third top failed, all the way back down to 4150, 4100s yesterday, and just hovering above that. And of course, you're seeing Solana again, Apex up, all the way back down, and wouldn't be surprised if we actually went lower than that 210, 215 handle. So just keep an eye on that. We know that the next week or so is probably going to be a little bit more negative, net negative for the likes of the crypto space, but it'll be something I'll be watching into the latter end of September, first week of October, really looking to establish where the bottoms are for the corrective moves, to then start looking at, right, next Fed meeting is October the 29th. We know that they're probably going to cut rates again. Well, we certainly seem to have that belief based on current rhetoric. So when we introduce a lot of these macro fundamental pieces, that yes, there will probably be short-term volatility to the downside, but we do believe it's probably going to be more a temporary move, and not something to be like, I need to sell, and a little bit more a cooler, calm presence is needed just to navigate this short-term wave of downside volatility. So just be kind of mindful of that. Could we see Solana at 200? Yes, we could. Could we see Ethereum at 3,800, 4,000? Well, probability is yes, I would expect that. But it's really just evaluating those corrective movements. And then, of course, you can use themes like, you can use your 50-week simple moving average, SMA is what they call it. You can use them as kind of curves to kind of evaluate where corrective moves would come or potentially align to. And that is obviously something that you can do with your indicators tabs if you want, just to kind of additional buffers to see that if there is markets correcting on the higher time frames, looking at maybe potential entries, looking at potential narratives, where could I potentially look at? And of course, I have a simple, this is an EMA one, it's not an SMA, but even on the weekly, you can see that the 20 EMA, which is exponential moving average, comes in at around about 3.7, right? If you go to a daily, you can even see at the minute we've technically broken under the 50, but we are moving back to the 200. And of course, you can pivot that from EMA to SMA and so on and so forth. So simple tools like that can maybe give you a little bit more reassurance if markets are maybe moving against what you might have liked or might have thought. It might just give you a little bit more of, right, well, these are the different barometers we can look at as complements for evaluating trend analysis. So just factor that in. But as I said, wouldn't be surprised if there was another week or two of maybe a little bit more negativity in the crypto space. I'm a long-term holder, so whether it's down today or down tomorrow or down next week, it doesn't really matter to me. It's all about looking at the bigger picture, looking at the broader picture, looking at the macros, looking at the seasonality factors, looking at the liquidity, as I mentioned there, with what's happening with Binance and some of these other institutions. Now, whether I believe a word of that, as I said, I think it's pure market manipulation at every step. I would tend to do the opposite with what people are saying. So if people are selling off, and we're seeing markets down 10%, that's generally where I actually like to buy. If you're buying on a 5 or 10% dip, it's usually in the longer run a better strategy to have than buying when it's 5 or 10% up and maybe chasing the market. So just be systematically aware of that within your processes if you are in this space, because it's definitely something we're seeing a little bit of a contrarian approach where cryptos is down in line with the September seasonality, at least in the last week aggressively, but we haven't seen those cracks other than today play out. But that's what I said. This is why the VIX at this 17 handle for me is so important over the next few days, really to see do we break out, because of course every time we come into this 14-15 handle we do get a little bit of a bounce back to 17. We saw it multiple times in August, we saw it at the beginning of September, and of course we've seen it this week again where markets is back up into that 17 print again on the VIX. So this is obviously something we have to be very, very careful of as well, because obviously higher VIX prices will generally create those corrective movements. Might only be temporary, might only be the session, but it's creating those pullbacks in the likes of the S&Ps, the NAS, and some of these other risk-denominated assets as well. All right, so that's kind of where we are on a macro scale, just on a purely on the week. Now, of course, this week as well, if I did forget to mention, we do have the S&P. Now, last week we had the Bank of England, we had We had the Fed, we had the BOJ, and we had the Bank of Canada with 4 big interest rates meetings last week. We've obviously got the Swiss this week, expected to keep rates at zero, nominal rates at zero. Obviously, press conference on Thursday morning. Unless you're big into the Swiss franc, probably not something I would be massively interested in reviewing. But of course, from a macro perspective, obviously looking to see if there's any deviations, but I don't believe there will be. We are in a net neutral or net negative rate cycle at the minute across the board. And we're seeing it even, as I said, in the likes of the Swiss, in the likes of Japan. We're not seeing increasing rates. All of the major kind of G7, G10 are obviously in a rate cutting cycle, with exception of those few that aren't actually obviously cutting. So important to keep some context and things as well. Now, the last thing obviously I want to focus on is the DXY, right? The DXY, we talked about this aggressive bottom last week. I did get a short last week from up here around the 136.40 handle. I didn't opt to take it through into the weekend. I was actually away from Friday afternoon. I was really taking price at around about the 135 handle, purely because, of course, price action had created this consolidationary piece, had this massive apex up, had the inside structure. So we've obviously got the wick rejection on the daily. You can see it there very, very clearly on the daily. On the 4-hour structure, inside movement, breakdown, a little bit of a pullback, started to show fragility on those lower time frames. And we actually obviously talked about this last week on Thursday quite vividly. And of course, we sold down, pause, V-shaped bottom, or break lower, should I say, into a V-shaped bottom, really reacting off of the value area on Friday from Thursday, and actually continued moving lower. So once we got into this lower bound around 135, I was happy to take a lot of profit off the table, because it's really back into this value area here. And we talked about this last week. I did say it on Thursday. The likelihood is we would see price coming down into that 134.50, 135. And lo and behold, that's exactly what happened, because there's a lot of volume down here. You look from left to right in this area here, just trying to encapsulate just the volume approach with nothing else. A lot of volume in this area. So this is really where you're kind of looking to see would be come down, and that's exactly what's happening. We did break marginally below it. We're now still stuck in this range. We're back into that 135 print again, and we're seeing a little bit of a bounce off of that 134.50 lows from yesterday. So again, I think the next move is going to be brought about by what happens with the DXY, right? Because of course, DXY, this is the bounce back. I mentioned it on Wednesday off the Fed. Interesting to see if we get a break back above that 97.50. Then I followed it up on Thursday and said this 97.50, 98 was going to be critically important, because of course what happened here was, with aggressive move, we went back up, and we went from 96, 97 all the way up to almost 99. And I was wondering, would that happen? But I was conscious of the fact that we had a fairly systematic period of consolidation plus successive breakdowns, right? We'd lower low, followed by corrective movement, failed at this area here, which was around about the 98 handle on the index. Then, of course, broke down with multiple wick rejections. We started a fade. We went down again, retesting structural lows. Then, of course, we had the FOMC volatility, wick down, held. We got our short-term correction, right? This short-term correction. And then it was into that 2-3 day kind of structural pullback, right? Of course, pulling back, back up into this 97.50, 98 handle, of which we talked about vividly on Thursday. And we said this was going to be the key thing on Thursday afternoon into Thursday's close. Would markets actually hold up? And as I said, it started to fail here. And then, of course, we got that cyclical rotation initially on Friday into Monday. And then, of course, since then, the DXY has broken back underneath this 97.50 and back into this short-term period of consolidation, which is basically between 97.20 and 97.50. And this consolidation here, it's about what happens here next, right? This is the short-term flow of volume. Do we come down? Do we break down? Do we extend lower and retest these bottoms again? Or do we actually see this dollar try and bounce again off of this midpoint region? Now, the problem is here, this is midpoint, because of course structural bottoms have been formed twice. We've got structural corrections, but we didn't break trend because we're seeing successive lower highs. Okay, and I think that's important as well. You've got one here, and you've even the more recent one here. So just be conscious of the fact, if this, for me, if I was going to be bullish in the dollar, I would have expected Thursday to close above 97.50, and I probably would have expected Friday to close somewhere around 98, 98.10 and really try and take out that volume. If that happened, then what I immediately would have looked for would have been a similar type of move, but from a higher pitch point, which would have been coming back down and holding that 97.50. So maybe something like this, and then look for that kick on back up into this prior area here. But ultimately that didn't happen, right? That didn't really happen because of course it was a marginal break above, and then of course a subsequent close back underneath. So this is where the cable moves kind of finished. But then from there, we're seeing price structure in the FX markets become quite consolidated, right? You only have to look at price action over the last probably 12 to 16 hours in cable. At one point this morning, just after the open around 9:30 this morning, we were wicking down, trying to break down, and then by 3-4 hours later, 5 hours later, we were at the highs of the day trying to break out. Symbolic of consolidated correction markets, and it becomes even more clearer on the 15-minute prints when you look at the volume. This is the volume for the session, breaks down, fails to initiate or follow or see a medial follow through, and then of course just grinds back to value area. So that for me is a nothing trading day. When you see price action like that, unless you're trading the 1s or the 5s or maybe the 15s, really very little to go on, right? If you're a higher time frame or even a day trader where you maybe look at the 15s, the 30s, the 1s, very, very difficult to get any sort of reaction on that because your daily range is so tight, right? You're looking at a 30-40 point range on cable today. Very little to kind of go on that, right? Same again with the euro dollar, but a slightly different style of formation because of course the euro dollar, it got a correction and moved back down to this yellow area, right? So this for me is more interesting because of course it's higher high, retest, structural continuation break, massive wick volatility last week in the FOMC, obviously clear break. Now I'm going to just remove the SVP for seconds, the volume profiles. This for me is telling, right? This massive wick takes the highs, induces buyers in, induces buyers, and then completely shits the bed, breaks down, comes back underneath, gets a little bit of a direct consequential move away. So there's no surprise that all this happened in a very, very short period of time, and in fact within hours, right? So from last Wednesday's FOMC at 6 right through till the end of Asia session where we get that aggressive break into 118. So we've gone from 119.20 to 117.90 in 12 hours, right? And then of course we get that knee-jerk reaction back up, creating lower highs, and then we see the further follow through into Europe, into the US session, and that pullback down into this yellow area again where we'd potentially mentioned last week. Now again, with that DXY coming off of that high, this euro dollar has been very sensitive and very reacting. So we've seen the pickup in the volatility curve in the euro dollar over the last few days. Very, very aggressive selling, but aggressive buying off of the back of that, and we're now sitting at that 118 handle. So similar to cable in this tight conducive range, euro dollar on the session is very back and forth, right? It peaked this morning at 4 a.m. It's become very, very corrective through the course of the morning, through the course of the afternoon. Now it's back into the highs again, but we're really looking to see what happens here. If this DXY opts to break down again, really sub 97.20 into that 96.50, 96.70 handle, which is really down here in the midst of this yellow area, then you're really expecting that euro dollar to incrementally take out these highs and then try and go again, right? And that's really then you're looking at peak formation highs. Well, you're looking at breakout, initial break and retest, extended move, apex back down, breaking above, and then this area then becomes into range where basically what you're looking at is higher high, higher low, price action really looking to take this on, and with the possibility of potentially taking out this wick. So this is really area 1, which is just around the 1850 handle, which is about 30 points above the breakout on the session at the high of the day today, but symbolically you're needing really to see a more elongated move higher, but that would be contingent on the DXY breaking down. So let's see what happens on the DXY. We've obviously formulated lows. We haven't seen any sort of, this is the fragility with the dollar at the minute. Every time we get a bounce, it's short-lived, and I think that's obviously something that we obviously have to be very conscious of because we saw it in April. V-shaped bottom, consolidation, short-term, right? We saw it move new lows, again, short-term. This very fragile, short-term. So you want to see more. Otherwise, what's going to happen is it's just become a lot more ziggy-zaggy as we approach the latter end of the dollar correctional cycle, right? So what you tend to see is in any sort of aggressive trend, very, very sharp selling initially into a more elongated, tighter, segmented move like that. So the differential between the highs and lows become less severe, and rather than seeing very, very straight line selling or buying, it becomes a little bit more ziggy zaggy and a little bit more correctional. So that's why you just have to be marginal of that. Do I think we could still break below 96.50? Yes, absolutely. But it's contingent on some of these data prints this week, because as I said, you've got core PCE, you've got GDP numbers coming out, you've got a Swiss National Bank, and you've had some fairly mixed PMI data today, which has already seen some highlighted selling into the close tonight. Now, albeit we're seeing markets hold up into the close, we're seeing a little bit of a rebound off of those lows, but that's at these yellow areas. These volume profile areas are really giving us those anchor points. We see it time and time again, week in, week out, markets reacting off of these areas because it's where volume is most heavily traded at. So naturally, we have to be watching these like a hawk. And that's regardless whether it's the S&Ps, regardless whether it's the NAS, or regardless whether it's the Dow Jones. So keep an eye on these three levels over the rest of the week. I think this is going to be the pivot area to see whether we get a midweek reversal and we kick on higher, or we get that systematic breakdown off of data, a little bit more negative fundamentals, and actually the markets create a correction, at which point then we probably look at last week's lows. So then you're really bringing in the FOMC Wednesday moves, and those extensions from Wednesday being the next port of call for any downside correction. So just keep an eye on that. Candle closures are key. Breakdowns through value areas are key. But we'll be on board tomorrow for the US Open. We'll be on board on Thursday as well, really to kind of gather a clearer viewpoint, as I said, into the better part of this week. But as I said, markets stay a little bit more stable in FX, very consolidated. Indices corrective, but again, that's not much considering how aggressive it's been even since last Wednesday. Crypto obviously down and moving lower, and as I said, wouldn't be surprised if we saw 108, 109 on BTC by Sunday's close. Ethereum really looking at that 4,000. If we break through kind of 4150, 4100, I think this just breaks down. If you look at the Ethereum level as well, 4150 would change. I think if we break this down, we incrementally go for a new low on Ethereum, which for me is 4,000 with potential for lower. And as I said, Solana, I think if we break through this basically this 213 to 216 handle, I think we incrementally go lower, and that's really into 205. But wouldn't be surprised if we got another kick back into maybe 200 or 190 as well, just depending obviously on the percentages that if markets were to sell off, how aggressively would they do it as well. And of course, last but not least is gold, right? So this was probably one of the cleaner moves that we've looked at all month, right? We talked about it into FOMC, we talked about it last week. That aggressive move on Monday, that kind of inside bar rejection, we talked about it on Tuesday into Wednesday. That happened off the FOMC. Markets went straight back into this value area. So we talked a moment ago about the value area, why it's so important. This was the previous kind of week's trading volume. You can see where it's most heavily traded at, and that for me is between this 3630s, 3650 range. It's probably more closer to a 15 to 20, but it came back down. And this is where markets consolidated. It wasn't below it. It wasn't taking out the liquidity. It was in this region. And that's where volume was usurped and taken higher. We got the initial bounce. We got the corrective move on Thursday. Market re-cemented those lows into Friday, formulating lows. And then, of course, what happened? Friday got the break. Multiple holes on Friday above the value area in the session, and once we'd really taken out those highs Friday afternoon into the open at 3660, for me this was going to go higher. It was going to try and look to take out these short-term lower highs, so incrementally here at 3672, this secondary wick, but incrementally the value area at around about 3680, and then incrementally then 3700, of which we've done that. So by Friday afternoon, we were trading at those high 3680s. Then, of course, on Sunday into Monday, we opened up. We continued through the 37s, and it's literally trend continuation. Okay, so it's interesting that gold is up. Digital gold, being BTC, is down. Seasonality factors. The dollar remaining a little bit more consolidated, but on the back foot. So back foot since Monday's open, but consolidated and kind of tilting lower on the session. So as I said, keep an eye on that 97.20, because if this breaks, you probably go lower. You probably see the euro dollar trying to extend higher, and you see cable trying to extend higher, which basically means how extension do we move, right? You're talking cable going back into 136, euro dollar probably going back into 118.75, 118.80, potentially even 119 if it wants to go for the wick. So keep an eye on that one as well. We'll update these tomorrow as price action develops through the course of the session. Volatility curve becomes important. We're at that 17 benchmark. It's going to be a structural break or bounce. The only thing I would say is on the VIX is you have gap here from last Thursday, not filled. You've gap from Sunday night into Monday, not filled. So there is that if the markets was to do a U-turn and the VIX was to sell off from 1700, just keep an eye on some of these levels down here. Okay, so this ballpark figure around 1550 becomes an interesting range. But we often see it that the VIX kind of marginally goes higher than it goes lower. It takes the VIX, it takes the gaps, and then it fills them. Okay, so just be kind of conscious of that. But even already, we're seeing the VIX come off that 17 into tonight's close. So interested to see how that opens tomorrow. Of course, we'll be on hand to look at that in real time. So that's really where we are at. It's going to be an interesting week, as I said. A few important data prints. Next Monday, next Tuesday, the end of September, the end of Q3. Then we move into Q4. We talk about the next Fed meeting. We talk about these data prints, and interesting to see what the teams and the narratives are into Q4, where we're expecting a little bit more bullishness. We're expecting a little bit more risk on with some of the sentiments, some of the narratives, the timeline. So let's see if that reaffirms as we move into October. All right. Have a great evening, everyone. We will be back tomorrow for US Open at 2:20. See you all then. Take care.